Welcome back to our fourth session of the day. This time we'll begin the fourth session entitled Prospects for Private Equity and Asset Management in the Changing Economic Environment. For this session, we would like to welcome back Ms. Henny Sender from Hong Kong. Please join me in welcoming Ms. Henny Sender once again. Henny?
Thank you so much.
Thank you.
It's a pleasure to be here, and I am going to take one moment for a professional lapse, so please forgive me. Four of us on this panel are permanent residents of Hong Kong, which is testimony to the fact that Hong Kong is an international financial center, and we are a vibrant financial center. There's been a lot of talk in the earlier panels today about the complications of life in a world where the US and China are sparring, and concern about the extent to which Hong Kong is a victim of it. The death of Hong Kong has been reported many times, but I hope after this discussion you will be convinced that Hong Kong is as vibrant as ever. Please don't write us off. And I am very disappointed that I couldn't convince Chairman Jun to move this whole thing and have all of you in Seoul come to Hong Kong. And now I will start by asking my long-term friend, Shanwei Chen, to start with how he sees the world and the investment climate today from his seat.
Thank you very much, Henny. First of all, it's a great pleasure for me to be here and to be on the panel with so many distinguished peers and speakers. I would just make a few remarks and hand it back to you. With regard to the prospect for private equity industry, of course, we're talking about the context in which we find ourselves, a pandemic, a virus-induced lockdown, and Asia is coming out of the lockdown, whereas the rest of the world is somewhat behind. I think in a crisis like this, those of us in the investment industry becomes even more keenly aware of the fact that that is a double-edged sword. In good times, that can help you generate better returns. But in a time like this, that can be very deathly, fatal for those firms who all of a sudden find that their cash flow is interrupted, that survival becomes priority, and therefore cash and liquidity become critically important for the survival of the business. And we at PAG has always followed a philosophy in our investment strategy, which is to take the first priority to preserve capital. Capital preservation is priority number one, which means we have been very cautious in using debt, knowing the double-edged sword nature of debt in private equity. So what we have found lately is that in Asia in general, our portfolio companies are in very comfortable position when it comes to cash and liquidity, because by and large, we're very lowly geared. And many of our portfolio companies are in net cash position, and therefore they don't have to worry about extended lockdown during which cash flow is very much curtailed. Whereas in the US and Europe, where we also have portfolio companies, the debt level is typically much higher. And we found ourselves in a more difficult position of having to work with the banks to, for example, waive some covenants, impose some kind of moratorium on amortization payment. And fortunately, we're in good shape, but it just reminds us that in private equity, as generally investment business, that is some risk that we'll have to consider. And this is time to remind everyone of that. And the second takeaway from the crisis that we're facing now is, some businesses may permanently have changed their nature. I would say that hospitality, entertainment, sports, and those businesses probably will take much longer to come back, and people will have to think about businesses which require a lot of personal interaction. Whereas e-commerce has proven to be very resilient during this crisis, whether it's related to entertainment, Netflix, or Tencent Music Entertainment, which we are a major shareholder, and those businesses are doing not only just fine, actually better in this crisis. And I think e-commerce in general are doing better during the crisis. But if you talk about the hotels, the airlines, entertainment, Broadway shows, those businesses are being decimated. So you have to wonder how long it will take for them to come back, and if they're not permanently impaired, and whether or not they will come back at all to the previous or pre-COVID-19 levels in the foreseeable future. So I would say that there will be maybe a permanent shift of where investment dollars go when you look at the landscape of personal consumption, private consumption, as an area for private equity, especially here in Asia. The third point, and last point I would like to make, is that in previous crises in Asia, we were always worried about the fragility of the financial system. I actually started my private equity career in Korea. The first deal that I did was to acquire Korea First Bank. We started negotiation in 1998. We concluded negotiation in 1999. We bought control. At that time, meaning Newbridge Capital, which I was managing and leading, we bought control of Korea First Bank. In fact, more recently, I wrote a book about that particular transaction. The title of the book is Money Games, the inside story of how American deal makers saved Korea's most iconic bank. And the book will come out in October of this year, in a few months. But that experience has taught us that the financial system underpins the entire economy. When the financial system becomes fragile or fails, then the entire economy is thrown into a chaotic crisis, as we saw in 98 and 99 in Korea. But this time around, I think Asia, by and large, had learned a good lesson from 97, 98 Asia financial crisis, and has bolstered the capital of financial institutions. So by and large, in Asia, financial institutions, especially banks, are very resilient. And therefore, I think the COVID-19 induced crisis will be short-term. And we should expect the economies, whether it's in Korea or in China or in Japan and elsewhere in Asia, to come back in the next 2 to 3 quarters. And therefore, the prospect for private equity investments in Asia remains quite bright. And that is my view. Thank you, Henny. We can't hear you. You're on mute.
Myself, you can hear me now, yeah? I'll come back to you, but before that, let me just ask you one question before we turn to Ming. And that is, you mentioned that there's much more leverage in the US and Europe. Does that mean that what your portfolio companies in Asia are telling you is we're fairly resilient? Other than the few sectors that you had mentioned, whose businesses are challenged by COVID?
Yeah, if you look at private equity acquisition financing is much more available in America and in Europe. Typically, you can get up to 6 times EBITDA acquisition financing when you buy a business, both in America and in Europe. In Asia, in Japan, until very recently, I think acquisition financing has been quite available. China probably is an exception where acquisition financing by and large is not available. You can get offshore financing, but onshore financing is very difficult. I just look at our portfolio companies in China, where we have probably about 15 portfolio companies. The debt level is exceedingly low. For many of our portfolio companies in China, we have a net cash position. For example, Tencent Music, we have $3 billion in net cash. Yuran Dairy is the largest dairy business in China. We have net cash position. Zhenai.com, which is the largest matchmaking business in China, is net cash position. Lily English, which is English tutoring business for children, net cash position. Golden Apple, which is a kindergarten business, net cash position. Yingde Industrial Gases, producing oxygen, nitrogen, and the like, largest in China with 40% market share. The debt level, this is extremely cash flow stable business. When MBK bought Daesung Industrial Gases in Korea, the debt acquisition financing was 7 times EBITDA. But for the business that we have in China, which is much larger, Yingde Industrial Gases, debt is only about 1.5 times, net debt, only 1.5 times EBITDA. Not that we don't want more debt, we just couldn't get more debt, given the lending environment in China. So by and large, this has become a disguised blessing in the crisis, that all the portfolio companies in China are so lowly geared that you don't have to worry about cash and liquidity in the crisis.
We'll talk about other Asian countries, particularly India, which are the outlier there, where the banks are having difficulties, and whether you see opportunities in more distressed markets. But now I want to turn to Ming. Actually, I remember so clearly, Sean, when you were doing the first bank deal, and you were spending so much time in Korea. And I think it's interesting that the first deal that I ever talked to you about, Ming, was also a Korea deal. And that was the deal that you did for Mundo. And what was fun for me about talking to Ming at that time was Ming grew up sort of in a more operational world than a financial world. Ming, let me ask you, we've both moved on. You're at KKR now, running all of Asia. You know, in a post-COVID world, how have you altered your investment approach? Why don't we start with that?
Yes, thank you, Hanny. You still remember that was the transaction that we closed in 1999, so long time ago, was of course a very successful investment. First of all, let me thank you, Hanny, and also the organizer, IGE, to invite me to be on this panel. And I want to say hello to everyone, particularly to my distinguished fellow panelists, which we are unable to meet face-to-face, and to be able to be in one room to engage more interactive dialogue, which is a part of the behavior changes I'm going to discuss as how this will impact the post-COVID investment approach. Last few months has been anything short of extraordinary time for us, with many, many unprecedented challenges. The challenges, even though like Wei Jian and myself have been in the industry for a long time, we've never seen that before. And so it's a very unprecedented. The COVID pandemic actually has led to many behavior changes, which could have a significant impact on the businesses that we want to invest in. The behavior changes we have observed is in multiple dimensions. Consumer behavior changes. One example is the entire millennium has been living on eat out culture, but they now have to relearn cooking in culture. Some of them may actually view this as a necessary evil you have to muddle through. Some of them actually may feel very enjoyable and they may continue. So it's a behavior change, both short term and longer term. Working behavior changes that instead of working all in one office, and now we have a dispersed, distributed remote working environment. Business environment changes, behavior changes. We used to categorize business into cyclical, non-cyclical, as judged by volatilities of the earnings and revenues. That actually gets thrown out of the window because in the lockdown, every business is volatile. And communication changes, behavior changes. You see that the internal meetings, external conferences like this one, and even exhibitions and performance are all move online with dispersed performers and audience. And the human interaction changes as best evidenced by the social distance. So all those behavior changes are bound to have a very significant impact on the businesses. We also observe that the impact on business varies from sectors to sectors. And not all sectors actually face a negative impact. Some sectors actually enjoy a positive impact through the COVID. And then the impact also could be both short-term or maybe in some cases longer-term and even permanent. As COVID continuing to evolving, it's not over yet, it is too early to just draw any definitive conclusion on what behavior changes and associated impacts on businesses are likely to be long-term or even permanent, or what are the impacts are likely to be short-term and quickly revert back to the pre-COVID normal. So for us as a private equity long-term investors, we really need to get our arms around this impact, whether it be a long-term, short-term, positive or negative. And so fortunately, what we have in KKR is that we have a very rich data in large number of portfolio companies cross global. And when you have a cross geography portfolios, you can observe the business behavior differences throughout the different stages of COVID, from lockdown to reopening to the recovery. And our portfolios also cover large variety of industry sectors. So you can also observe the behavior changes or differences across industry sectors. And we pull together our cross global, cross industry, cross functional people with expertise to give us insights and analysis. That actually can help us really get our arms around on the impact. So what we have found so far, and take a step back, I'm very pleasant surprised that we have been pursuing what we call the thematic investing approach, whereby we identify the thematic sectors in various markets we believe they will enjoy long-term tailwinds. So we've been investing behind that. And those thematic sectors actually have been passed tests and been revalidated through the COVID, as evidenced by the resilience of our portfolio companies on aggregate and on balance, which I'm quite happy with that. We have quite a few investment in the businesses that focus on consumption, domestic consumptions, quality services that are capturing the rising share of wallet of middle class. And in many of cases in the consumer staple non-discretionary sectors. And that actually shows a very strong resilience. We have a quite number of investment in the technology, digital players in Asia, and which provide online services for education, content, consumptions, and commerce. These are the major beneficiaries and enjoy exceptional accelerated growth during the lockdown period. Our investment in healthcare services initially experienced a negative impact, but they actually experienced quick V-shaped recoveries, which clearly indicated the initial impact, negative impact, is short-term, it's not longer-term. We also have a sizable number of portfolios that we invested through the corporate carve-out. Initially, many of those sectors they are covered in experience initial negative impact because of lockdown. But there is no long-term damage as the economy starts to recover, and our business actually recover very well. More importantly, the investment thesis really play out. We know that carve-outs deliver strong potential for cost savings and cash flow improvement. We're able to drive through that. That actually helped our portfolio companies sustain during the lockdown and now in a stronger position to recover. So those are the few evidence that gave us the confidence. But there are also a few lessons learned. Wei Jian mentioned that, which is very critical, the prudent capital structure, which in Asia we generally have a much lower leverage level, and the greater focus on cash flow actually is critical in providing the safety margin and the ample liquidities during the time of crisis. And the second lesson learned is every business, no matter you are a traditional business or the new business, needs to be digitally enabled, and need to have a very strong IT infrastructure to accommodate distributed remote working environment, online commerce or service provisions, or effective communication across your very dispersed employee basis, because they are in the very many different locations, across your supply chains, across your customers, and to your critical stakeholders, including government and local communities. And lastly, the business with the thoughtful, we call the business continuity planning, that able to deliver diversified geographic footprints, customer base, supply chains, as well as diversified IT infrastructure, we're definitely in a much better position to manage through the crisis. So with all those insights and analysis, I think that gave us a pretty good guidance as to where we can lean into the opportunities and to be more proactive. Just a few examples, as many of you know, that we have been very busy in the last few months, leaning into many opportunities that are created by the COVID pandemics or enabled by COVID pandemics as the COVID becomes a catalyst to drive certain transaction to the completion. And globally, we have actually deployed or committed over $18 billion globally. 7 billion of those 18 billion are in credit investment and 11 billion in equity investment. In Asia, we also have been very, very busy, signed and announced a number of larger transactions across a number of geographies, as well as less known to the outsiders, number of bolt-on investment for our portfolio companies as part of a strategy to help portfolio companies to consolidate in fragmented industries and drive accelerated growth through the synergies. And so we've been very, very busy. We know that every crisis creates opportunities, and we often say that we never want to waste a crisis. However, every crisis also comes with elevated risk and increased uncertainties. It is a wrong time in a highly uncertain world for us to be proactive in the areas we are not known. We're better to stick to what we know best. So the thematic sectors that we have been investing behind help us gain the strong convictions and develop a deeper expertise and experience. Those are the sectors we're leaning in. So our priorities in investing through this COVID pandemic is not geographic centric. It's actually thematic centric. And good examples on the 3 investments we recently signed and announced. We signed and actually closed our investment in Vietnam, in Vinhome, in partnership with the leading local family groups, which has had a strong track record of developing and marketing the high quality residential housing for rising middle class, which is exactly the investment themes we want to play in the emerging market by playing into consumption upgrade that tailor to the rising middle class with rising income. And you do it with the local, sophisticated, leading families that are like-minded and share the same vision with you. Same philosophy carries through our investment in Geo, which is investing behind the leading India family in the digital platform that provide the digital product, services, and the solutions to large populations and large small and medium enterprises in India at affordable price. And Geo has been showing the strong track records in the last 3 and 4 years, actually executing this vision. This is playing to another investment theme, which is investing in the digital and technology platform that actually can transform the consumers and local businesses. Our recent signed announced investment in the Colonial First Systems in Australia is a carve-out investment in the leading wealth and the retirement benefit administration management platform. Through the carve-out, we can actually more focus our resources and investment in upgrading the digital IT systems, enhance the customer experience and the services to them, as well as driving operation improvement in still a fast-growing subsegment of wealth management in that market. So clearly playing into our corporate carve-out themes. So you can tell that in times of rising uncertainties in crisis of this proportion, we just need to stick to what we know the best and what we actually prove in the crisis that should be working. In other words, our thematic sectors investment. So with that, I turn back to Honey.
Thank you so much, Ming. We're going to come back to you to talk about ESG, technology, and geopolitics. But now I'm going to turn to you, Rebecca. I don't think that the name of Premier Partners is as well known as that of Shanwei Zhen or of KKR and Ming Lu. Premier Partners is an entrepreneurial startup in Hong Kong. It invests in ETFs. And Rebecca, one of the interesting things throughout the day was the constant references to China-US tensions. At the same time, we had, for example, Sui at Canadian Pension Plan talking about her portfolio. And she singled out Meituan as an example of why you want to be in China. You know, and Ming had referred earlier to scale and the need for scale. And, you know, Meituan tells you how small people think about when they're not thinking about China. It aspires to 100 million deliveries a day. You know, can you talk to us a bit about whether you think, you know, that because of these tensions, people may wrongly be underweight China? And since the other big theme of the day was technology, and, you know, KIC spent at least half the time talking about their technology investors. You heard a lot from Ming when Wei Jin was referring to Tencent Music. That has to be one of his most spectacular investments in, you know, consumer internet and entertainment. So talk to us a bit about, you know, one of your TFs that I think is most important, which is the new economy, and how China plays a role in that.
Thank you very much, Henny, and also Dr. Jun and your colleagues at IGE and other host organization for inviting me again. It's a great honor and pleasure to join such a distinguished panel. As Henny kindly mentioned, I run Premier Partners, which is a relatively young ETF manager with focus in Asia strategies and pretty much growth strategies, because we look at the space and decided that the major gaps that a lot of investors are more keen to have more interesting exposure for are really in two areas: the growth economies, especially for China, and the growth sectors. So I fully agree with what Shan and also Ming just mentioned, all these exciting opportunities. In fact, we have now 6 ETFs listed in Hong Kong, covering not just China, but also, which is a sister strategy with our China New Economy, is the Asia Innovative Tech. Recently, a lot of the Korean companies, for example, Citrian, Naver, Kakao, they are doing very, very well and has contribute a lot to the performance. We also have Vietnam and ASEAN, which we consider are actually beneficiaries from the US-China tension. And contrary to what a lot of people are thinking, instead of outright moving or reconfiguring their supply chain to something outside China, most of the people, the entrepreneurs, and also the multinational CEOs that we've been speaking to, they're actually more thinking about, as they expand their supply chain in the region, to look at Vietnam and ASEAN as the China plus one solution. How do they better integrate their current supply chain arrangement to fit China, and also so that they can have a better hedge in case of even heightened China-US rivalry. And our friend Kevin Bong at GIC just mentioned also about thinking fast and slow. In a way, we think of ETF sort of as a thinking fast tool that allow investors to be also more nimble as they participate in a lot of these very exciting growth areas, and perhaps also with a bit less emotion at a time like this. You can imagine, for historical reasons, a lot of global allocators, they typically have been underweighting China for various reasons. And even with the MSCI inclusion, many people who are not spending enough time on China typically would just use the cap-weighted ETFs for portfolio completion. But as you can imagine, as what Shan and also Ming just described, a lot of the interesting opportunities are actually happening inside China in the onshore market. And as China continues to go through structural transformation, the differentiation between the old versus the new economy players have become even more pronounced. We've been actually a very big, I guess, silver lining beneficiary since COVID, because we have this new economy strategy that Henny you mentioned, which has been performing already very well last year because of the mega trend leaders. But it continued to do very, very well, especially this year since COVID, and has a year-to-date return of over 21%. The Asia Innovative Tech that I just mentioned also has a 14% return. And the strong performance really come from very specific new economy sector leaders in medical equipment, in biotech and pharmaceutical, in cloud computing and network security, in enterprise digital transformation. The consumer space in China has already been very, very digitized. And now the interesting opportunities that a lot of investors, including private equity and venture capitalists, are looking at are actually in the enterprise space. And Industry 4.0, including renewable energy, are also very interesting because of the policy tailwinds that China has started to introduce. For example, during the recent two sessions in Beijing, there are a lot of new policies and also support programs that were announced for the new infrastructure initiatives. In fact, Goldman Sachs has also recently made an estimate that just for new infrastructure related capex, China is going to have more than 2 trillion this year, and twice of that in 2020, representing a growth of 20%. So there, and so you can imagine a lot of the differences between the old and the new, because unless a company can really adapt to the new mold, it would be a very difficult and challenging environment for them. And during COVID, this is especially pronounced. In fact, you and I have been joking that some of the cloud players in China should pay the government a marketing fee, because if you try to compute the normal user acquisition cost of usually, I think the industry average is around $30 per user. Imagine Ali, the Ding all of a sudden had 300 million users because the Ministry of Education imposed all the classes to be conducted in cloud. All of a sudden, they're saving $9 billion US in marketing fee. Think about that. So when investors look at exposing or positioning for China opportunities, I think it's important to think about whether you want to follow the conventional cap-weighted approach, which would give you mostly the mega cap companies like ICBC or even multi, or do you want a new economy-focused strategies that allow you to participate through a lot of the megatrend opportunities like the urbanization, the rising middle income class, and also new infrastructure, the industrialization, build out, etc. that Sean and Ming also talk about. But in the past, most investors, namely the asset owners, the high net worth individuals, are the only people that have access to these very strong performing strategies in private equities. Nowadays, we also have the liquid option of participating through ETF because technology and data analytics technology these days have allowed us to capture those opportunities quite adequately in a systematic quantitative approach. And in our ETF, which you like so much, in fact, we also put in a quality factor screen. So a lot of the things like what Ming and Sean mentioned about having the staying power with strong cash, strong balance sheet, strong profitability, actually factored into our strategy as well. So maybe with that, I will pass back to you, and let's also see what other panelists would share with us. Thank you, Kenny.
Thank you, Rebecca. I'm going to ask you one question quickly before I turn to you, Bana, and that is, it seems that in a low interest world driven by the central banks, there are two trends, binary trends. On the one hand, you go more and more alternative, and you're paying the fees in the hope of outperformance. And people like Wei Jin and Ming are trustees of that. And on the other hand, you want to take advantage of this huge liquidity, which washes over everything, but in a very low-cost way. Are you a beneficiary of that sort of barbell approach that many of the pension funds are adopting?
We are definitely. In fact, our largest investors, they tend to be asset owners and insurance companies that already have exposure to these type of new economy strategies through their private equity allocation. But they also use our ETF as a portfolio overlay and the liquidity sleeve so that they can continue to be exposed to these trends and also the new economy players, but also with the option of dialing up and down their exposure because of the intraday trading and also the daily liquidity features of the ETF. It's part of the cash equitization strategies that we always like to say.
Thank you. Thank you. Banu, I'm going to you, the outlier in Australia.
Apologies, I can't be in Hong Kong.
Your argument for systematic investment is precisely that it doesn't depend on a single macro environment. Talk us through how Dimensional sees the world.
Thanks, Henny, and thank you for the invitation to be part of this esteemed panel. It's fascinating to hear about the challenges and the opportunities in private equity world. We do mostly in public equities, so perhaps that's considered a little less boring, but we think there's been plenty of excitement here as well in the last few months. So Dimensional got started as a micro cap manager back in 1981, before anybody thought of recognizing that as an asset class. So when we got started, we bought some of the smallest stocks listed in US exchanges with very little liquidity. So from the very beginning, we spent a lot of time making sure the portfolio was designed to be not only well diversified, provide that return associated with small caps, but also be suitable for large institutional investors as they were our primary clients, and for them to have liquidity when they needed it, even though it was a micro-cap portfolio. And I think that lesson has come in very handy in the last few times the markets have seen this kind of volatility. And the way we view the world is that we think markets do a pretty good job of pricing in information. It's very difficult to figure out what's going to happen in the world ahead of time. So what you can do is you can spend a lot of time doing the research properly to identify the big drivers of returns and capture them in cost-efficient portfolios, and spend a lot of time paying attention to implementation. We think diversification is your best friend. That is very evident in the last few crises as well. Back from GFC to late 90s to the 97 Asian crisis to the recent one, where a lot of clients found that even though they were in strategies that were perceived to be diversified, so one of the things that we've seen recently is a huge trend towards factor investing or quant or systematic, whatever you want to call it, with a fair number of names in these strategies. But what people found was that during times of volatility, the liquidity was actually hard to come by, which we think is a big problem because when these when this type of volatility shows up, it actually represents an opportunity to be able to rebalance. One example is, for example, in the fixed income world, credit spreads have been wide for a very long time. So you haven't gotten really paid too much to take on credit exposure beyond perhaps the top tier. So if you go into single A's, triple B's, and even some of the high yield, the spreads haven't been wide enough to compensate you for that additional volatility you're taking on. But when third week of March happened, the spreads blew out to quite attractive levels. But if you were holding portfolios that weren't able to rebalance because they weren't able to access liquidity in the markets, then you weren't able to capture that opportunity. So I think what we found out was designing portfolios with built-in flexibility so that they're well diversified. They don't trade on, for example, reconstitution dates only. So if you're tracking an index and you're rebalancing once a year, twice a year, 3 times a year, you're beholden to those dates when your reconstitution happens, or you're stuck tracking an index. What we believe instead is that you should trade when you need to. So we monitor our portfolios every single day, and we keep an eye on market conditions as they change, and we rebalance them. What that means is when things change quickly, we're able to react quickly. So I think that was one of the main lessons we saw come through again during the last volatility episode in March. So our main aim here, Henny, is to design portfolios that are rooted in a very high level of academic research. Based on valuation theory. We think prices matter a lot. We think cash flows matter a lot. A lot of the same principles that the other panelists covered in their private equity investments and opportunities discussion. And once you pay attention to those big things, then it's all about implementation. So we've been investing in global equities, global fixed income for, almost close to 40 years now. So while it wasn't a fun episode to go through in last March, it was interesting to see that things worked as we thought they would.
Do you worry about crowded trades? Every time there have been corrections, I was sitting in New York in 2007 when a lot of the quant funds had this meltdown, and all their brilliant algorithms couldn't identify the crowded trades. And that turned out. Have we solved these problems?
I don't think you can solve those problems because you don't know which one's going to be the next crowded trade. So I think it's all obvious after the crowded trade happens. It's not so obvious ahead of time. Now, you can do a lot of things to not be on the wrong side of that. One of that, like I said earlier, diversification is your best friend. Using multiple sources of expected returns is your best friend. If you're putting all your eggs in one basket, perhaps that's microcaps or one sector or one factor like quality or value, you're going to have a tough time when that factor underperforms. And they do underperform from time to time. Just like stock markets go up and down, these factor premiums go up and down. So as long as you take that into account, as long as you understand the distribution of outcomes, and then you plan for them accordingly, and there's nothing better than holding a well-diversified portfolio that you're able to look at every single day and bring a level of human oversight on top of that. There's no better defense than that against these things. Now, look, markets go down. When they go down, your portfolios go down. There's no way around it. But what you don't want is that your portfolios to be fragile to the point that when they go down, they don't come back up, right? Because the liquidity troubles drown them, or you swung the bat so hard in chasing returns that a bad episode basically dissolved the fund. So we keep that in mind from very beginning as we design portfolios to make them quite robust to episodes like these.
Let me ask you one final question before I turn to Mr. Kim. And that is this, everyone talks about diversification. And by definition, a crisis involves a factor that suddenly correlates seemingly diverse classes, geographies, sectors.
Right.
When you try to think about what could be the correlation, what could be the vulnerability, what do you come up with?
Well, My professors used to say, you can do all the work you want on expected return estimations. It's the covariance matrix that takes you down, because that's the most important thing in the world. So, and covariances are very, very difficult to predict. They're not stable. And as we all know, all correlations go to 1 during a crisis. So you can, I think the danger there is that you optimize too much on past data. And optimizers can be very seductive, where you're chasing that next decimal point of precision when it doesn't really exist. It doesn't tell you anything. So while we use a lot of models, we use data, we use a lot of econometric tools, at the end of the day, we use them to learn about the world, then we step away from them. To us, the best model in the world is the market itself. So when there was a lot of discussion around opportunities in China and opportunities in the onshore market versus offshore market, you can see the capital flows around the world and how they're moving from developed to emerging to China, onshore to offshore, and so forth. That's market telling you how to allocate capital. So for us, market's always the good starting point. It's always a good portfolio to hold. Then you come up with reasons why you may want to differ from the market. Perhaps that's in pursuit of higher returns, because you want to focus more on things like higher profitability companies, or value companies, or smaller cap companies, or private equity for that matter. So you deviate from market portfolio for a good reason, but the market's a pretty good starting point. And I think that saves you from getting seduced by quant-sparing models. That's as was a popular phrase in GFC. So I think we spend a lot of time looking at data, looking at models, but you'll find patterns if you want to find them. Data is not that big yet, and computing power is cheap. You put enough smart people in a room, they'll find you patterns. So what our goal is to say, well, what can we learn about the world, and what do we expect to see in data, and then use those principles that we have learned about to implement real-world portfolios, and then we keep a close eye on them day on day, paying a lot of attention to implementation costs, things like trading costs, things like turnover, and so on and so forth, because those things we can control. I can't tell you what the market's going to do tomorrow, but I can tell you what my trading costs will be if I go into the market tomorrow and trade in a hurry. I can control those. I cannot control what the market will do tomorrow. So we focus on the things where we think we can add value.
Thank you so much. I'm going to turn to Mr. Kim now. Mr. Kim?
Speaking.
Thank you so much for joining us today.
You're welcome.
Mr. Kim is actually, has experienced personally the challenge that we've all talked about in a world of social and physical distancing, because Mr. Kim is actually meant to be a global real estate investor, but how to do due diligence in a world where you cannot travel. So talk to us about how the COVID virus has forced you to change your whole investment process and direction.
Okay, thank you. First of all, thank you for having me here today with these distinguished persons. As Mrs. Sanders said, so we are in a very difficult situations. As everybody knows that the COVID-19 is giving a very bad negative impact to a lot of industries. Our companies, Hana Alternative Asset Management Companies, is also one of the companies which has a very negative impact from the COVID-19. Because the reason is that our companies just focused on the alternative asset businesses. I guess you know that the alternative asset business is usually the private style, has a private style process. So all kinds of transactions are done based on contact style activities. However, this environment does not allow any kind of contact activities. For example, usually our company has closed transactions annually, 20 or 25 transactions. Among them, over half, 60 or 70% is the cross-border deals, and remaining 1/3 is domestic deals. However, until the end of June this year, during the first half of this year, we closed no deals because environment does not allow any kind of contact activities, very serious. So during this conference, I would raise one issue because everybody, I guess everybody knows that, also everybody is thinking that even though the vaccine for the COVID-19 is developed in the futures, however, everybody is thinking that any other kind of the pandemic disease will happen anytime or anywhere. So for the sustainable alternative asset businesses that we have to develop other kind of business process. So during this conference, I would raise the related parties of alternative asset businesses have to develop virtual due diligence process. If we stick on the real due diligence process and the parties which has related to real asset businesses cannot do anything. For that, I think as you know, the recent scientific knowledge and the technologies the level is very high. So if we use the technologies and scientific knowledges, we can develop the virtual due diligence tools or process. However, for that, so if we can develop the virtual due diligence tools, however, the using of that kind of tools that we have to acquire a huge understanding of related parties. So for the developing the due diligence the tools that the related parties, investors, asset managers, and policy makers, and regulators have to participate on the developing the tools. This is the first issue. And also the second is that the more rapid securitization of alternative assets are needed very quickly. Because the alternative assets businesses so far the needed contact activities, and securitization the level is very low. So this kind of situation will continue, and these alternative asset related businesses cannot go further. So I would raise this kind of two things. First is that the developing virtual due diligence tools, and second is securitization of the alternative assets. And one more interesting thing is that under this kind of environment that our company have to survive. So we are now changing our strategies. So far our company just focused on alternative assets. We are changing into the private debt areas and the corporate financing, because the reason is that the corporates or the companies recently need some more huge liquidities, because they want to prepare for the very indefinite the future. However, this kind of change of strategy is just temporary. So for the sustainable business, I would like to suggest the development of virtual due diligence and the accept of the developed virtual due diligence style by related parties. And the second is the securitization of the alternative assets. So for that kind of business that the regulators and policymakers and investors and also other related parties have to have so a big interest in those businesses? Thank you.
Dr. Anna, I'm going to turn to you now. We haven't had a chance to talk, but let me ask you, I mean, Mr. Kim is the most dramatic example of how you have to reinvent yourself in many cases, you know, and I will come back to him to ask him what he thinks his business will look like in 5 years. But before I do that, maybe you can talk about how you see the investment world once this virus has passed, whenever that is. How different is it? How reversible is it?
Yes, actually, that's the most critical question. Everybody, wants to know the answer to that question. I don't think that I do have the answer, but let me discuss and bring up some issues, with respect to that. We have about, 7 participants in this, panel session, and probably I'm the only academician. And once, actually, I used to be the work at the Royal Bank of Scotland, but that's the sell side, not buy side. And I left the industry about 11 years ago. And so probably, rather than I'm going to discuss the very practical stuff, I'm going to come up with, some issues, pertaining to, the impact of the this pandemic on the capital market as well as the overall, global economy. Okay, I think that there are, a couple of implications of this pandemic crisis, for asset management and portfolio management. In the short term, we have, a dramatic sell-off in the equity market. For example, in the NASDAQ, NASDAQ goes down by, 30%, but in 2 months, it recovered whole loss, and right now it actually surpassed the previous peak. And all those, quick recovery has something to do with the enormous amount of liquidity injection made by the global, central banks, as we know. And definitely it, bolsters or boosts the preference or appetite for risk among the major, investors globally. Well, given that the equity market has reached, its previous peak, now the problem is that it's very difficult, to predict the future direction of the equity market overall. It's very, so there is strong possibility that, we're going to actually face short-term volatilities in the next, 1 or 2 months because there is a huge gap, between the global macro economy and the capital market, especially the equity market. And this decoupling was warned, by the IMF a couple of days ago, and already the equity market has priced in the very full, efficiency of the fiscal policy as well as the monetary policies. But we know that this COVID virus is a very slimy and a creepy animal, and it's very difficult to expect, when we're going to come up with a vaccine or the, cure medicine, for that. So, and also, we expect that this virus will be dampened, during the summer. But right now, we have the summer in the northern hemisphere, but still the virus is very resilient and it doesn't go away. So at this point, I think we have a horse race competition between the virus and fiscal policies / monetary policies of the major countries and also emerging markets. If we fail to, dampen this virus by the first half of next year, I think a couple of countries will be in deep trouble because their financial ammunition is run out of, so that we might have some sort of a local fiscal crisis, and also with respect to the monetary policies, major countries including the U.S., UK, Japan, and European countries would be okay because they are using the key currencies as their base currencies. But the emerging markets, which injected a huge amount of liquidity into their domestic market or domestic economy, they might be in troubles. So I think there is a lot of discussion. I missed the morning discussion, morning session, which must have discussed the future prospects of the global economy next year or and so on. But at this moment, I think we have so much uncertainty about the recovery path of the global economy. So because of that, it's, all the governments as well as the central bank should be really prudential in using their ammunitions, of their next, 1 year. In the long run, I think that there is some, in the short horizon, of course, asset managers should be concerned about how to deal with the turmoil, caused by the COVID virus. But in the long run, they have to be really concerned about how well positioned their portfolios are to deal with the upcoming dramatic changes that are waiting in the pipeline. What happened is that, the post-financial crisis period, so since the 2008 was dramatically different from the pre-crisis, which is summarized as the new normal period. So it is characterized by the sluggish economic growth in tandem with the low inflation, despite the enormous amount of the liquidity injection. In addition, we observed irrational exuberance in asset markets, such as the equity market and the real estate markets. And such inflation in the asset prices worsened the wealth distribution among people globally, and that actually summoned some sort of the political populism as well as the deglobalization. In addition, during this time, we observed increasing, increasing debt, either in public sector or the private sector, and that the pandemic crisis is happening amid the backdrop of all these, adversaries. So everybody argues that the post-pandemic, era will not be the same. Then the question is how it will look like after the crisis. Will it be located on the extrapolated path of the previous new normal, or will it change its direction and enter into the uncharted territory? I think that's the critical question, but nobody can actually come up with the sure answer to that question. So collectively speaking, such changes, which are already ongoing in the investment universe, will test the resilience of the every asset manager and challenge them. So the asset manager should be well insulated, against these changes to protect their portfolios. And right now we are talking about what would happen after the pandemic crisis. But before that, we have to be also well acquainted with what happened from 2009 to last year. That is post financial crisis period. Actually, in this session, I
think we better, we just have so little time left.
All right, yeah.
So I just want to leave a little more time for discussion.
Okay,
So,
sure.
Sorry. But I just wanted, much of the conversation during the day was about geopolitical tensions, the friction between the US and China. Wei-Jin, I'm going to turn to you for a moment. Wei-Jin is one of the most detail-oriented, bottoms-up investors I know. And I just wanted to get a sense from you, Wei Jin, when you're doing your due diligence about companies, do you just look at them? You know every single detail about them. I think you may know more than their CEOs often. Do you think about geopolitics and the other global external risks at all when you look at a company as a potential investor?
I wouldn't say that we would know more than the CEO of a company. If the CEO of the company wants to know more about his company, of course, he or she should
For you
know
to invest.
thoroughly about it. But we do leave no corners or no stones unturned. We do thorough due diligence when we invest in the company. We underwrite our investments at two levels. The first level is macro. That is looking at the market conditions, looking at the macroeconomic trends. And if we think that, as Lu Ming pointed out, there is a tailwind, that gives us the confidence to look at businesses within that market. If we think that there's a headwind, of course, we will hesitate. So geopolitical implications are extremely important for us. And if we think there is, let's say, a tension between China and the United States, in fact, the past 10 years, we have not invested in any export-oriented sectors, not because we were thinking about tensions between China and the United States, but because we thought that the export sector will cease to be a principal driver of economic growth in China as costs of inputs, especially labor costs, increases over time. And now I think it is even more difficult to invest in businesses which cater to foreign markets. That is the Chinese manufacturing businesses which cater to foreign markets. On the other hand, if you look at India, for example, we do the opposite, because Indian rupee has been very weak and has been very volatile. So if you invest in the domestic business in India, you will have to worry about currency risks. And the cost of hedging India rupee is exceedingly high, maybe 8% per year. So it's unaffordable. So for India, we are much more interested in businesses which outsource. So they receive hard currency as their revenue, and they use their input is denominated in rupees. So macro and geopolitical considerations are very much a part of our consideration as we look at investment targets.
Thank you so much. Ming, I'm going to turn to you now quickly. Everyone has been talking about tech. Everybody loves tech. Tech has been the biggest beneficiary of the pandemic. Are you worried that tech has become overvalued?
Yes, technology for us actually includes three things. First, as an investment proposition, or the technology companies generally are providing a fast growth. As a result, they constantly need capital. In that category, our focus is really focused on what we know best. In other words, the business model that actually has a very clear path to near-term profitability. We don't believe the business that can grow just by burning cash without seeing the significant improvement on unit economics. So that is very important. This is mostly involved earlier stage investment. And then the second angle is the later stage. There are some businesses that already become mature and continue to generate strong growth. That actually plays into our normal strengths of as a later stage investors. What's in between is using technology and the digital capability to drive the next stage of value creation for the businesses. As I mentioned earlier on, you really need to have your investment, including those traditional business, being digitally enabled, technology savvy, so that they can actually distribute, communicate, or use the online channel. to drive the customer service, product development, sales, marketing activities. And that actually is inevitable. If you fast forward any business 5 years from now, decade from now, any business has not done such transformations, is going to be struggle very, very severely. So those are what we consider technology plays. I think through the COVID, there's clear technology opportunities become bifurcated. The business that actually continue to generate strong unit economics, driving strong growth with improving unit economics, and or even profitable, continue to attract a lot of capital, and the valuation is hold up pretty rich. And on the other hand, the business that's burning cash have no clear path to the future profitability in the near future, and unit economics is questionable. I think they have a hard time to raise the capital, and they will force themselves to go down route. And so if you talk about valuation in technology space, those are the bifurcated. But the key is ability to find the first category, and they're still at the earlier stage, and then you can get them.
Thank you so much. We have very little time left. Rebecca, I'm going to turn to you. Give us 1 or 2 minutes to talk about a company in one of your portfolios that is the reason why people should feel optimistic about new economy in Asia. You know, both Wei Jian and Ming talked about middle-class consumption as a big theme. Talk about tomorrow's theme and a company that exemplifies it.
Okay, it is a very big topic, and I think
2 minutes.
Overall, the new economy, the many new economy sectors are very interesting because they have both two things, like we just mentioned, because of the tailwinds from COVID, acceptance of technology-enabled processes, and also the business models are increasingly gaining a lot more traction compared to before. Like the marketing saving of getting user acquisition that we mentioned is a huge saving for most of the new economy players in e-commerce, in across many new economy industries that require user traffic. The other thing is also, especially in China, I think Industry 4.0 and new infrastructures are really very important policy tailwinds that a lot of international investors may be less familiar with, because it's easy to visualize or even generate excitement from e-commerce, e-gaming, esports, a lot of the consumer-related technology-enabled sector leaders. Whereas enterprise digital transformation, and because they are big, so they are less easy to visualize the opportunity from it, but it's actually growing very, very fast. And is if we say that the consumer digitalization space is maybe half or even 70% done, the enterprise digitalization or the digital transformation in China and in Asia is only scratching the surface at the beginning. So for example, because of the COVID, like we mentioned, a lot of cloud players and Alibaba and Tencent Cloud, they emerge as the obvious leaders. Some of the less obvious leaders are actually the cloud security, the network infrastructure leaders in China. For example, one of the companies called Yongyou in our new economy ETF, and also the other one which is called Session4. They are the domestic leaders in cloud security and also enterprise application.
Thank you. We're out of time. I just have a few words to wrap up. I wanted to thank all of you. Mr. Kim, I look forward to next year's and hearing how your transformation works out. Dr. Banu, I'm so sorry, we're out of time. It was a pleasure.
No problem.
And once again, my compliments to what Dr. Choi refers to as the big boss, Chairman Jun. Thank you both. Thank you all so much.
Thank you, everyone.
Thank you. Thank you very much to our moderator. and our participants. At this time, we will have a very short 5-minute break as we set up for the final session of the day. There's some coffee in the back that you may help yourself to, and I will see you in 5 minutes' time.